Good evening. I'm Dan Fitzpatrick at stockmarketmentor.com on Wednesday, December 11th. And I want to talk about MasterCard. Look, the stock jumped up today. It was like big high-profile guy because they announced that I think they're increasing their dividend by like 83% or something like that. They're increasing their share buyback program, and they're also going to split 10 for 1. Meaning for each share of $790 stock that you own, they will give you 10 for $79. Okay, that's a pretty good deal because a lot of people, for whatever reason, won't buy 10 $790 stocks, but they'll buy 100 $79 stocks. Whatever your metric is. So these stock splits apparently work. You know, they also add a bunch of liquidity to it. But on this, I wouldn't be buying MasterCard just because of a stupid stock split. And I love stock splits. Last century, wow, if you weren't trading stock splits, you weren't trading. But here, the stock gapped up. Can't really gap up because of the dividend. Okay, it only pays 0.31% right now, and so they jack up the yield. They raise their dividend by like what, 80%, 85%. Okay, so big deal. So now it's up to what, a 0.5%, like 0.55%. The bottom line is that isn't the deal. What's interesting to me is the buyback. If they're going to continue to buy back their shares, okay, that's great. You're taking some off the market. At the same time, you're increasing the liquidity by 10 times because you're doing a 10 for 1 stock split. So what you got to do is, and I teach this stock split, I call it a strategy, but it's really just a frame of reference. What you really want to do with MasterCard is, once the stock has split, take note of the price, where the price that it trades at during the when it splits, and then if the stock stays above that split price for a while, then it's okay to buy it. It's okay to own it. But if the stock, wherever it starts trading at, let's say it split here, $790. So let's say tomorrow it starts trading at $79. As long as it stays above $79, it's fine to be owning that stock. If it starts trading below $79, then you know that part of the reason the stock has been up has just been a lack of liquidity. So suddenly there's 10 times more shares on the market, and it's easier. The trading is more liquid. Suddenly the shares start to fall in price. You don't want to be a part of that stock. So anyway, that's a forward look at a stock split strategy. But for right now, I would want to stay away from this stock until it fills a little bit of this gap. It's got to come back here a little bit. If, however, and this is a big if it doesn't, the high price was $801. You might set a price alert for $802. If MasterCard starts trading above $802, go ahead and buy the stock. It's going higher. You'd think that it wouldn't, but hey, when the stock came up to here, then started rolling over, who would have thought that 650 was not the top? Okay, so these things do stuff that you don't think they're going to do, but afterwards you look at them and say, like, how could I have missed this? So wait for the stock to trade back into the gap. If it doesn't do that and instead breaks out, that's when you buy. One of two. It either breaks out above today's intraday high and you're buying, or it falls back into the gap, then starts showing some firmness, and then you buy. Okay, members, over to the strategy session. Talking a lot about different aspects of trading and managing your risk. Okay, and that's like the most important element of trading, so listen up.